Um,
Right.
thank you for your help, Nicole. Oh, thank you. I saw the name.
Yeah.
Perfect.
But I'd like to know.
No.
Did they go, as soon as they find out, then I want to make sure I'm not looking something.
I'm with you.
Because I'm here for you guys. Oh, Lord, I'm getting good. Okay.
I don't know how to start this
Okay,
here. Which I just want to make sure you're. Oh, there.
go, what's the there? Okay.
Yeah, that is right.
There.
There you go.
Okay.
Back and forward.
We're just gonna record
Yep.
there? Okay. Let's see. Is that gonna be a distraction? I'll put it on the other side. I'll put it right here. Here we go. Had to bring some love to the office.
Yeah, I'm gonna give you that. Let me just jump in.
Hi. I'm just, hi.
Oh, no, that's the TV.
That's what you handed me. I thought, oh, no,
That's right here.
no. You gave me the pointer. I was
That's right.
like, that doesn't look like.
Very easy.
Okay.
I'll be here in a few minutes.
I'm like, started.
Oh, so she's not coming.
No, but she's sending the food.
So she just wants me to.
Yeah, so just mention her.
I'll be right back, guys. I just need to go.
Oh man, I'm not prepared for this.
You don't need to know that, you just mention.
I will. I will.
You don't have to explain the book of business. Oh, no, I'm going.
It is. Right back here.
What's y'all doing?
Call. Long call.
Oh, like for helping a buyer. Pricing that like helping a buyer.
Yeah.
Okay, yeah, that's good.
And then the simple showing property.
Yeah.
You want to get a 24,
Right. All right. No.
but learn how to do the maps or show the door bow. Yes.
Yeah.
I didn't see it.
If I'm being on.
Firstly, she said this with like just using like the search things. It's a lot easier.
Right. Well, yeah, the map feature is useful, like you're talking about where you can center it on an area and yeah. You can play with it. No.
Want me to get started?
Oh,
You want to do the introduction?
1 minute.
Should take it back that you can have never read it yesterday. It actually helps with my posture. I'm not like this, man. Hey, are you guys gonna be able to see those? You were going. I do.
I'm not on this.
Oh, yeah.
You're young, you should start working on your posture. I mean, I don't have great posture, but make sure you keep going, because it. But it's so. Oh, man, I thought it was just. And you know. It's not, yeah, I don't know the other day.
All right, we'll go ahead and jump into it. Welcome, Wednesday Lunch and Learn training here at the Real School Garner. Now we have to put that because we do have a new Fayetteville location. My name is Keith Bonham. I'm the education director and one of the instructors here. Couple of announcements. We do have CE Jen up from the North Carolina Real Estate Commission and also some electives on the schedule. If you go to the realschoolnc.com, we have some coming up in person here at the Real School Garner. We also have some coming up on February 18th and February 25th in Fuquay, out of Anna Powell's office. So we'll be doing some, actually, those are gonna be all day events. So if you want to knock out both, all your 8 hours, you can do that either on the 18th or 25th there. We also have a Gen Up here on March 7th in person. And of course, we have virtual offerings through our partnership with the CE shop. So if you want to do something at home, you can do that. Our lunch sponsor, unfortunately, was not able to make it, but we're going to go ahead and give her flowers anyhow. There's Miss Laura Wiltz. She's the area manager for First American Home Warranty Plans. They've got some new enhanced plans and upgrades. Just to let you know, their plans start at, for a single family home, $495, and condo, townhome, or manufactured home at $435. We have brochures at the school. If you want more information, grab a brochure for your buyer. And I think that's it. So we're going to call up Miss Lisa Penny with Movement Mortgage, and she's going to talk about some interesting things to help our buyers out.
Yes, thank you. And sellers.
And sellers.
That's right. Okay, guys, I'm Lisa Penny. I'm with Movement Mortgage. I know a lot of you, but I do see some new faces, and I think that's awesome. And a friend of mine came from a different office, so I love that too. But I just wanted to go over, we tend to have an issue, where those sellers are just so worried about selling their house prior to buying, because what if they're homeless and so forth. So we're just going to talk about bridging the gap, because you hear a lot of terms. I'm going to go on this side so I don't block this. You hear a lot of different terms about their bridge loans and home equities and how do I get the equity out of my house and move forward. So that's what we're going to be doing today. So it's like, will a seller accept my contingency offer, source of down payment assistance for repeat buyers, and then will I qualify before my home is sold, and then who do I call first? So if you've learned or been to any of my classes, you know that I get a little bit detailed, and I'm sorry that I'm a detailed person. So some of this, I'm not expecting you to remember it, but I'm just expecting to just plant the seed. So when this issues come up or questions come up, you can go, oh, I remember Lisa may have mentioned that, because it gets complex. There's nothing more about real estate and lending. You get further into it, it has to become more complex because it's such a tough market for our buyers, and especially our first-time buyers. So just that's a little caveat there. So we're going to be going over a home equity line of credit compared to a bridge loan, and then down payment assistance, because there is down payment assistance even to those that are not first-time home buyers, borrowed secured funds, and then grants. Okay, so what we're doing first is going the home equity line of credit. So lenders will go somewhere from 70 to 80% of the equity of the value of the current home, and some may go up to 90% of that value. And that's going to be minus the outstanding balance. So if the value is 100,000, they will go up to 80. I'm sorry, that's easy math for me. I go a different number, and that's not going to happen without a calculator. And then the other thing is interest rates. Most home equity line of credits have a variable interest rate, which is based upon prime, but they may also be able to get a fixed rate conversion on that to keep their payments, more steady if they're worried about the adjustable on it. Closing cost and fees, it will have closing cost and fees. Some lenders, it's going to be 0, but they'll bump that rate up a little bit. And then some, it may be 1,000, and some it may be a little bit less. But I will tell you, as I go through these options, you're going to find that this is going to be something that's going to really save your customer a lot of money, but we just have to make sure we set it up properly. Whenever you have a client, the first thing when they say, oh, I'm thinking about selling my house, but it's going to be 6 months or in a year, the first thing we want to do, we want them to open that line of credit as soon as possible. If you know someone that has a lot of equity in their home, I recommend that they go ahead and set up a line of credit. But set up that line of credit at the maximum that you're allowed. Because number one, it may provide you a better interest rate. Even if you brought it up to 100 and 150, you're not charged that amount. You're only charged interest and payments on what you borrow. Think of it as a credit card, okay? The reason is because I have some clients that have taken out home equities, but they're 50,000 and they had $200,000 worth of equity in the house. So go ahead, the sooner they get it, the better, okay? And there's reasons for that. And but I encourage it anyway, because what if a person's wanting to buy something and they're going to be paying it off in 2 months or something? Home equity, then pay off large payments, you'll probably get better interest rates on them for the time frame. If the home is not sold, if the home is or to be sold, a lot of lenders will not do a home equity line of credit. So we don't want to try and set this home equity line of credit when they're thinking of buying a house. That's the reason I'm saying if you talk to a buyer or seller and you know they have a lot of equity, just say, have you thought about a home equity line of credit? Call Lisa, she'll go over it, because I'll go over the positives and negatives and what we can do with it in the future. Because there is one or two lenders that will do it as long as the house isn't on the market. Now, you may ask, well, how's the lender going to know? One of the questions on a cash out home equity line of credit is, what is the purpose of this loan? And they're signing paperwork. What is the purpose of this loan? So if they're not going to buy for 6 months to a year, just say, I just want to have my equity available because I may be buying a house in the in 6 months to a year. I'm not really sure. But I want to have the access to the cash. Or you can say, I just want access to the cash. But just know that is a question and they'll be signing paperwork. So I always like to say that, because what happens after closing is one thing, but when you're having to sign for it, some clients are really going to get nervous about that. Payments may be interest only or principal and interest. This is really great, guys. Principal interest only, because that just means we're only qualifying them on the interest only on most of the programs. There's going to be some programs that we're going to have to, do a qualifying rate much higher. The other thing is qualifying payment may be based upon a percentage of the line of credit. So if they open this prior to closing and they have their existing house payment, the lender knows they're going to get a house or buy a house because it's already sold, they pulled credit by another lender on their credit report. So there's a lot of different ways. Then they may be using, for qualifying purposes, 1.5% of the maximum line of credit. So if it is 100,000, they're going to be using, for qualifying purposes for that line of credit, 1.5%. Well, you throw that in with a new house, an existing home payment, and the home equity, makes it more difficult for the customer to qualify. But if we're coming in with, they'll have that payment, it will help them to qualify for that home equity line of credit. The sooner, the better. Okay. And again, and a lot of clients are like, I don't need 50,000, or I don't need 100. I don't need 150. But what if they do when they're ready to buy the house? If they never borrow against it, that's fine. It's just like a credit card. Okay. You do, again, I want to emphasize, sometimes you do get better interest rates based upon the amount of the line of credit versus what you're borrowing. And then qualifying for the new house. Keep in mind, we're going to have the existing home payment, a new home equity payment, and the new house payment for qualifying with this type of mortgage. And of course, for all disclosures, always check with the financial advisor for guidelines and policy. And then the home equity line of credit, with this home equity line of credit, it is then going to be paid off when the house is sold. So it's automatically paid off. I really wouldn't want a customer to go up necessarily to $100,000. I mean, 100% of their value, because then we want to make sure that if the house sells, they have that buffer for paying commissions and so forth, and any other costs that they have associated with that line. So I like the idea that you cap it no more than 90, even if it's available. Just they need some wiggle room, because if the house sells for less, we just want to make sure we've got them covered. Okay, so the benefits does not affect the interest rate on the first new mortgage. So a lot of people don't realize, if we do the if we're doing, you'll find out in just a moment, if we're doing a home equity on the new house, it's going to affect the first mortgage payment because the first mortgage payment is considered a higher risk when we know there's another lien against the property that they're going to be paying on. So we're trying to keep these payments, the payment on the first mortgage, not affected by what they're doing with any home equities, be it an existing home or the new house. Funds available for due diligence on the new house. Funds available for repairs and prep before they put it on the market, and then pay off debt to qualify. And we can put it on the home equity. If it's an interest only, then that car payment or whatever the case may be, we have to have a large conversation with the customer of what all this means. But then that payment is less because it's based upon the home equity interest rate, interest only, typically interest only, versus a car payment. Okay, but keep in mind they'll be paying that off with that home equity later. Payments are interest only. I just wanted to emphasize that. So then the next, okay. Well, that's interesting. I know, well, I basically know what it is. So the next one is supposed to be on the screen. Is it on my computer? Well, I'll just tell you. On the next one, this is getting a purchase money second. And I apologize, I had a long list here too. This is getting a purchase money second. That is a difference. The purchase money second is they take out the first mortgage and they do home equity on the new house, and it's all on the new house. And it's a purchase money second. We will be qualifying them on the first mortgage payment and the existing payment. And then, of course, just the PITI on the existing home. And then on the new house, just these two. And then it's often can be fixed rate. It's going to be, or interest only payments on that as well. The disadvantages is going to be you didn't have the funds to pay any closing cost up front from that, or you can use it for closing cost and down payment. But I'm sorry, I am used to seeing all that lines of information, but the disadvantage would be you don't have the funds up front to prep your existing house and have more of an option of saying, I can put this down, or, higher due diligence payments and so forth. But it's referred to as a purchase money second. The advantage for after the fact of closing, and they're wanting to refinance in the future with this program, we can put that purchase money second and the first mortgage, and they get the standard refinance rates. If I had a line of credit after the fact where they're trying to pull out equity after buying the house, then if I wanted to do a refinance and combine those two, it's a cash out refinance and the rates are higher. Okay, so again, I'm just trying to set them up. When I work with your customer, I get very detailed in what they're planning to do. And when I'm looking at a loan program, I'm not looking at a loan program just to get them into the house. I'm going to be looking at a loan program. Oh, they're going to want to refinance. Am I setting them up on the right path if the rates come down and get them the better rate later as well? How am I setting this payment up for them? How am I setting it up? Or is it going to be all of a sudden, this home equity line of credit has to be paid off in 10 years? What am I doing for your customer in the future? I'm looking for long-term as well, just not a quick fix to buy the house. And I apologize, all that's not in there. Oh, I know what it is. And of course, it is going to a white. The screen gave me a headache last night. It's got white font back there, so I apologize. Now, this is the interesting one. This is the bridge loan. Now, we've gone over the home equity line of credits on the existing home that we're looking at. Fees are very low in comparison, okay? Fees are very low if they get a home equity on the new house, that purchase money second, where it's considered on the new house. The fees for that cost is going to be lower too. Now we're getting into bridge. So here we are with bridge loans. There are numerous bridge loans available. A lot of us can broker them out to different lenders. When we say that, when we start brokering out and we're doing something a little different than most lenders are going to do, sometimes those rates and costs can be higher, but that we're just trying to meet the needs of the customer. So on one particular one, and I talked to a loan officer that has used this program before because I haven't, and I wanted to see what her experience was for her customer. They'll go up to 75% combined value on the house. So that what that means is they're going to take 75% of the value, less the first mortgage balance, and then those are the funds available for the down payment and closing costs in the future. Okay, so it's going to be the balance of the funds after the mortgage is subtracted. Funds may be used to pay fees, pay off debt, and then also 35,000 for home prep. Now this is a bridge loan. We're bridging that equity, taking it out to use it for the purchase of the new house. There's not going to be any payment or out of pocket expenses because it's coming from that line that they're opening up on that bridge loan. Okay, so there's nothing out of their pocket. The house must be sold within 6 months. One thing what they're doing is they are holding out of this money 6 months of house payments to cover for that customer. And it is a contract that they're writing. And at the end of 6 months, the contract says they will buy the house. But it's not going to be a pretty picture.
Who will buy
The bank that's holding this, the bridge.
halfway through, they decide they don't want to sell.
That's gonna, yeah, they're gonna have to do some, I can't answer that question because there's a contract. There's indirect, it's a contingency contract that if the house isn't sold in 6 months. So you wouldn't want to do,
No, I'm saying like if, let's say that somebody was considering selling, which I had somebody that was considering doing a bridge loan, they weren't 100% sure they wanted to sell. So then let's say they did the contract and said they're gonna sell in the next 6 months and then 3 months in, that, we want to stay here.
so that's a great question actually, because a lot of people refer to the home equity line of credits that I described earlier, the home equity line of credits and the on the existing house. A lot of people refer to that as the bridge loan.
Mhm.
And it is a bridge loan in the terms of you're pulling equity out, but it's not a bridge loan like this. This bridge loan is basically, and it will go up to 75. This is if someone's already buying a house, they're under contract, they're worried the house isn't going to sell, they really want to make an offer. This is like, this is not the ideal unless you need to do it. Okay, it really isn't the best thing for us to do, or if they need that mortgage not counted. Now, I have to put a clarification there. Oftentimes, the official bridge loan, like we're discussing here, they're wanting to sell the house. Banks aren't going to loan them the money because now they're in the midst of buying or going under contract. And they're like, well, you're going to be selling the house. I mean, the bank knows they're doing all this expense and they're never going to get a payment on it. It's going to be paid off within 60 days or so. Okay, so that's one reason a bank doesn't want to do the investment on a house that's going to be sold. This bridge loan is different. You're going to have a little bit higher interest rate. You got a lot more cost up front because they know the loan is going to end up being paid off. But with this particular program, the way it's set up with those 6 months being held, and we have a contingency, a non-contingency contract because they know they're going to get the money and they know if it doesn't sell, then they've got someone that's going to be buying that house. That makes it different where we're not going to be counting this mortgage or on the home on the existing mortgage on the house. It's confusing. This is like we can't get the home equity, or we need whatever the case is, or we need to have our payment for it's not going to be counted. This is your go-to product. That's the reason I was mentioning to you, please, let's get that home equity started. And actually on your customers, that it wouldn't affect their house. I mean, they have the home equity that they can use. They just need to set it up at the maximum amount for them. And then whether they buy 6 months a year or don't buy at all, that home equity is just there for their use. This is more or less, in my opinion, this would be like the last thing we would really want to do unless we needed it for that customer to be able to buy that house. Okay.
Is that written into the contract, 80%, the bank will buy it?
I honestly don't know the terms. I haven't reviewed, I haven't seen one of the contracts to review it, but I just know that that's the reason we don't have to count that payment. But we literally have to get like an extra exception under underwriting for it. Or at least it's a step above that we have to say, no, this is why we don't have to count it. So these are the steps. They're gonna meet with their preferred agent or lender. They're gonna apply for the new home mortgage. They're gonna see if they qualify for the bridge loan scenario. And then make competitive offers to move into the house and then maximum sales price. This is gonna help them prep the house before selling, so to get a better price on it. And then they're gonna sell their old house. Well, see, if we had that home equity line of credit set up for very little, $0 to $1,000 to $1,500, you're gonna see what kind of fees they're gonna get here. So on a house, there's an outstanding mortgage of $100,000. The mortgage payment is $2,000. The estimated price at the time is $450,000, and they're wanting to buy a $600,000 house. So here we go. This is the approximate bridge loan amount. 6 months of house payments come out of it. Look at our fees.
Wow.
Do you see why I'm encouraging you to talk to your customers and have them set up a home equity line of credit? And if I don't have the best product, I'll refer you to someone that does, or if I don't have the product that's going to give them the best terms, I'll refer you to someone. If I'm going to have more fees, and I'm going to be referring you to someone that I know has a really good product as well. Estimated bridge closing. So we got this cost. We got this cost, and then we have the $1,800 additional cost. The home equity may only be somewhere around $1,000 or so. You'd have to check with the lenders for their individual costs because it can vary. They can be expensive as well. It's going to keep your clients from making a contingency offer. The funding. So the funding payment is up to 50% of the new house price. So if the new house price is $600, we are only going to want to fund like a half. The down payment's going to be like a half, so we have more equity. But we're not going to give them the full amount. It's going to be up to 50% of that down payment that they needed. That is a little confusing to me, so I can put it in the numbers for a specific customer. Okay.
Just to be clear, it's gonna be 300,000 on a 600,000. Or 50% of the down payment total.
Correct. They're going to cap it for the down payment that they're giving out of this 200 up to where they're at 50% of that required down payment.
Okay.
But there's a cap, so your first mortgage may be a little bit higher, and then when you sell the house, you pay down that first mortgage and you request a recast.
Okay.
Keep in mind, recasts are not allowed on government loans. That's what I'm here for, guys. I'm just here for that. See, this is my everyday thing. Home prep to maximize the return, paying for moving costs and pay off secured or unsecured debt. What we're doing is we're trying to get that customer set up to go over, to have them set up to be able to qualify for the house as well. And the home equities the home equity and the bridge loans can get that debt paid off. Now, that's another thing I do. I really cancel with your customer because sometimes with this housing payments, it's such a shock. But with canceling with your customers, I may say, oh, guys, why don't we, instead of putting this much down, let's put only 5% down, and you have this much to pay off debt. That's going to make your housing expense, your whole budget expense less, and they can afford the house payment and feel more comfortable with that higher house payment. So now we're talking about grants, and I'm going over this pretty quickly because one thing is overwhelming. It's overwhelming even to me sometimes to compare all of these products. So then we've got the boost, and I have gone over this before with our program that we have, but this is an FHA product. We will go up to a 5% down payment. That gives them their 3.5% down payment and 1.5% towards closing costs. They will have to make a payment on that second mortgage based upon 10 years. The rate's going to be 2% higher than the note rate, but they're not going to have all these other costs, on this down payment assistance. They actually can go up to 56.99% DTI. Minimum credit score is 600. And then non-occupying co-borrowers are allowed. That's not the situation in all these combined loan products. And it's 1 to 2 units, manufactured housing available, and then origination is 1%. So it's going to be a 1% origination on this, plus any discount points if they want to buy down the rate. But this is, so you cannot buy another house that's fine that's FHA on your new house if you have an existing home with an FHA loan on it, unless they're 100 miles away apart. Okay, so if they have an existing, so I need to know what type of loan their current home is. But some people are using this program to help them with the down payment on the new house, and then they get the equity and they put it on the principal. FHA does not allow you to recast those, so their payments are always going to be higher. It's just going to be paying off the loan sooner or until they can refinance later if the rates were to come down. We also have a 4% down payment. Reason I'm bringing these up is they do not have to be, it's allowed for anyone to buy a house. It's not limited to first-time home buyers. So you always think about down payment assistance being for first-time home buyers, and that is not necessarily the case. And then so we got a minimum 3% down payment, 30-year fixed. The maximum LTV is 80.01 on our first. And then we've got the DTI, we have income limitation on this. We don't have an income limitation on the movement boost. And then we can't allow the MCC. We're talking about existing housing, and that would be for first-time home buyers. But that's the details of that. But that's another product that we have, which is a 4% down payment assistance that's not tied to North Carolina housing. North Carolina housing, we also always know that they have a great program at $15,000 down payment. It can be used with USDA, VA, FHA, and conventional. I often use it for my VA customers because they get 0 down, and then we have closing costs. And we can also use it to pay other VA funding fee. We can use it to buy down their principal, whatever the case is, to help get them the lower payment. This program with North Carolina housing is 3%. So you can use a 3% down payment, 0 interest on the second mortgage. It has to be paid off when the house is sold. Our movement, and I was just trying to compare all of those together. If you are interested in taking a picture of that, that's fine. But I was just highlighting that this particular one, you do not have to be a first-time home buyer. So now we're going to get into borrowed funds. That's strange. We put the wrong. I sent you the wrong version, but anyway, secured funds. I was trying to make this where this money is secured with a rock. In other words, trying to emphasize secured funds, not a credit card, not just money that I've had underneath my mattress, nothing like that. Secured funds. And the one I always ask when I talk with your customers, I ask for more than just what I need for qualifying. Because if something comes up in the transaction, I need to already be prepared for it, okay? So whether they're going to even consider 401k funds or they don't want to use it or whatever the case may be, I always ask, do you have a 401k? Because the 401k is one of the loans that they can borrow, and it's considered secured because they're borrowing their own funds. Then the payback is typically, they can borrow up to typically, because you have to check with the financial institution that's managing it for them. Typically, it's 50% of the amount they have vested into their 401k. And then the interest rate's typically better because it's for the purchase of a house. They need to let them know it's for the purchase of a house. And the payback period is 4 to 5 years. And they normally do it as a draw. I mean, as a ACH out of their payroll or something. There you go. I couldn't think of it. It's not considered a debt in most of the loan programs, conventional FHA. We get into some that's going to consider it as a debt, but we don't consider it a debt on most programs because if they don't pay it, we're going to be secured. So it'll just be their own assets that they take. Not that I would recommend it. Does not have to pay taxes on it. So a lot of people think, oh my gosh, I can't take money out of my 401k because I'm going to have to pay taxes. They're not taking the money out, they're borrowing it. So they don't have they don't have to pay taxes on it. And then they're borrowing their own asset. The payment on the other secured funds. What I meant by the payment on the other secured funds is they own a car free and clear. If they can find a bank that will loan against it, anything that can be secured by collateral. Okay. And then as well, plans vary per 401k institution. A lot of them, if they've already borrowed funds against it, they will not allow them to have a second loan In that scenario, I tell my clients check into getting a larger one than needed and combine them. Some financial institutions will not allow that, but that is a source. And I recently closed a customer. She owned her house. She was selling. She had a lot of debt for things that she had to do around the house and other reasons in life. And she was just so concerned that her down payment was going to take up so much money. And I asked her, I said, do you have a 401k? And she was just so thrilled that she had, and the seller was wanting a lot of due diligence money too, because they wanted to delay the closing. And she was just so thrilled. She had no idea she could do this. And she told me even at closing, I'm so glad I talked to you because now I don't feel, I still am going to be paying this back, but now I don't feel so strapped when I'm making this first transition. I have a chance to work on it. So that's one reason I ask your customers a lot of information, because I need to know that if you call me and say, or the house doesn't appraise, we got to change it, they've got to come up with more money, or now there's repairs that they're going to take care after closing, because it's just, they just know that that's something. That's one thing I do. Okay, so now we're coming into a little bit of open door. Okay, so we have a movement purchase power, Zoom Casa. So you may have heard of Zoom Casa. Think of it as they're going to be buying their house. Kind of like, I'm assuming that's what Open Door does, because it seems like when Open Door has it advertised, they own it. Okay, this is our version of Open Door. And a lot of people, there's a lot of fees, and we're going to get to it. But you already have sellers, or you already have customers buying where they had a seller that they just literally were willing to do this because it made it easier and took stress off of them, and they weren't really concerned about the fees. So you're going to see you do it and you get paid commission. Don't leave it up to Open Door to sell it. Then we have a product here for you. Okay, so the seller, they're concerned, I cannot afford if we do not sell this house. And then it unlocks up to 70% of the value of their home, so they're going to have some equity in their house. It's going to be cash out equity. Their mortgage will be paid off because the house is being sold. Okay, and then they can pay off debt. They can move at their own pace. Now that when I review that, I'm just saying move at their own. That means they had 3 weeks to move versus the day of moving, because typically they want it within a certain time. When I've experienced it with one of my other customers with a different product. And then benefit from the experts in preparing their house. So it's just like, I mean, they're going to buy the house. They're going to fix up the house just like anyone, going to renovate it and do whatever and put it back on the market. For us as a lender, we don't have to worry about the payment on the house that they're selling or their existing home. And may free up. So think of this as VA, because we've talked about VA loans. So a veteran has a VA loan. And he wants to sell, he just can't, but if he sells, or he doesn't, he's not going to sell it before he buys, excuse me. So he's not going to sell it before he buys, but that VA is that house that he is on, whether he qualifies or not, is going to use his entitlement, and he's not going to be able to borrow as much or not be able to borrow at all. So they may want to do this to free up his VA entitlement so they can use their VA. Well, if that existing home had an FHA loan on it and they needed to go FHA on the new house, it'll free up that loan for FHA. So again, we're getting deep, but I just wanted to let you know some of the benefits. No more property tax payments, insurance, and HOA, because they no longer own the house. And then improve client's balance sheet for debt to income. For a lender, it just helps us with the qualifying. Now, agents, you're going to hear, and you're going to win more listings by removing the roadblocks. I'm afraid I will be homeless. I want to buy, but I'm afraid I'm going to be homeless if I sell my house, because there's just not a lot of inventory. And the agent will have the ability to earn their compensation with this. You could have a house that you've listed, and all of a sudden they decide to go this direction. Zoom Casa, because we work with them, but I'm hoping your buyer will come back to me for their permanent mortgage when they're buying. But Zoom Casa will allow you to still be their listing agent. You're not going to lose that deal. And I think that's really important because you may start offering that a little bit more to your sellers that are like, but I may be homeless. This might be something we want to look into for. So it's 2 transactions, basically. Zoom Casa is going to take, if they're going to be, the departing residence is acquired. The initial payment is going to be up to 70% of the appraised value. Once the seller moves out, Zoom Casa prepares the home for sale. And then Zoom Casa, they now have it branded as Cash Offer Plus because they can use the money for other things if they have enough equity. Resells the house for top dollar with you. That's what's so important, with you. They're going to sell the house. You're going to be the agent. Upon the closing of the resale transaction, the seller is then paid the remaining equity. Remember, they capped it at 70. So then they're going to be paid the remaining equity when the house sells. And if the house sells for more, because they're going to go off an appraisal when they give you that offer or when they buy it. If they fix up the house and the house sells for $30,000 more, what happens? They're going to make sure your seller is part of that increased price of sale. Okay, so they fix up the house. The seller, they put it back on the market based upon improvements. That's just an example, because unless it's just market going up, you may not have the appreciation, but like with improvements or so forth, then the seller gets his part of those proceeds in that increased price. And you're going to get in the commission
If it sells
compensation.
for less.
I don't know the answer for that.
If it-
If it sells for less, they capped it at 70.
Okay,
So that just means they're going to get less money
from
One-
equity,
from the additional equity because they've already received equity up to 70.
got it.
So if it sells for less than, then they're not going to get as much as that remaining balance.
Got it.
Okay. So here we are. As is, the house is 400,000. The existing mortgage is 250. The initial advance is going to be 70%. The closing costs are about 1% of the sales price. And you got net proceeds for 26. Again, I'm using Zoom Costa's information as a disclosure. We'll have to check with them for all the details and cost breakdown.
Well, the closing costs for that, like who covers for that?
It'll be part of that 70% that they give them. It'll be taken out at that point. You're going to do a resale. Now, this isn't showing the appreciated one, but you're going to have the resale, the commission, 5%. The program fee is normally, in this set case, it's normally about 4.99, and then however months that they may have it, so they've got 19,960. And then they reimburse the prepaid home improvements. If there's home improvements and the house sells for more and it's more than what they've done, they're going to take some of that out of the home, out of the proceeds. It varies. They may have it, I'm buying this house, but we're going to cap the repairs at this amount. Anything over, it's going to probably come out of the proceeds that he would have gotten at closing. And the total proceeds including is 352. So basically, when you have someone that's in this situation, that's really when we need to see what's specific to that customer. And that's the way it's becoming on all programs, is it's just every customer is different for what we can do. So yeah, somehow when we were moving that around, so we missed out the grant screen. So I'm going to go over the grant screen. Grants, not all lenders offer grants. A lot of it could be, most of the individuals that offer the grants are going to be banks. And a lot of times it's not just the smaller banks, it may be the bigger banks. So that's what I've been working with, or that's what I'm discovering facts. I'm not 100% sure on that, only because if someone calls me and says, well, I got this grant from First Citizens, or I got this grant from whomever the big bank is, or a bigger bank, I like to call and figure out what it is, or why aren't we available to have it. And so some of them have the Federal Home Loan Bank grants. And we don't have access to that, so other lenders may not as well, and I know they don't, but, I don't want to speak for other lenders really. But what we do have is on those grants, I just want to kind of educate you on some grants. I've seen them as high as $10,000. I've seen them as high as 12,500 through DHIC. If your customer is going through a community partners loan program with $50,000 down payment, we were not even going to go there, but I've also seen them at 2,500, 5,000. So it could be that it's not based in one county. It could be that it's all of North Carolina. It could be that it's all of Johnston County, Wake County, and a few surrounding counties. It's very specific sometimes to location. It could be census tract. It's literally putting the address into the house. So we can't promise it to a lender, or a lender really can't promise it unless it's just going to blanket cover everything or everywhere that customer is looking. It could be driven off of their income. It could be driven off of, so there's maximum income limitations on some of them. And it depends on, are they first responders or something like that? There's typically something tied to it. Some of them have more flexibility, others may not. So that's the grants. I wish I could say something more about that. We do have one that's through Freddie Mac, and that's up to 2,500. But again, the person has to make 50% of the average median income, and that income is pretty low. That when we get to that point of income, it's harder for them to qualify. So I haven't had a lot of clients that have been able to use it that really needed it because of limits. So it's not just we're going to grant you this money to whomever. It is literally, there's a lot of different things behind it. So I know I've gone over a lot. I'm sorry that we have problems with the PowerPoint, but sorry about that. Any questions? And I apologize that I get detailed, but if I just say we have this, and then you don't realize that the complexity of just saying it to your buyer or your seller, because we don't want to get their hopes up and but it might not work out for them, or I may have something else in mind for them that will. Any questions? Are we in information overload?
Not at all, thank you, it was great
Yeah.
information.
Oh, yeah, thank you. And I'll try and see if I can get you something, a couple of screenshots or something that's just giving you that information, or you can just really honestly just say, call Lisa. I mean, I've been in the industry a very, very long time, 40 years, and actually 42 years, but with that, I just look at the whole picture for your customer, because the last thing we want to do is get them into a house and they can't refinance in the future because of however it's tied up, or for a long period of time, or either we're setting them up because they were able to get the house, but in 5 years, what are we looking at for them? And I look at the whole picture.
This year, if interest rates go down, how long can you recast for? 6 months?
Typically, no, before you can refi,
Recast if they wanna,
normally
What's that?
recast is within 90 days of
90
closing.
days, that's it.
And normally, you can do it more than one time. It depends on the lender or who is servicing the loan for us.
Got it.
That's recast, but recast is not allowed on government loans, only on conventional loans.
only convention.
And sometimes there's a fee of $500 associated to it. I always tell the client, you can recast your payment or you can continue with your payment, and I show them what they save if they're comfortable with the payment. If it ever changes when they're not comfortable with the payment, they can always go back and recast at a later date. And then on refinance, it's normally 6 months after closing. And interest rate, they're not expecting the rates to go, but maybe, and this is towards more the end of the year, and boy, it's changing every day.
I was gonna put you on the spot, not to do it, but what is movement saying? I mean, I know right now, and it's everybody's guess, but are they?
At best,
targeting
they're thinking 6.5 to 6.18 would be the lowest we see. And they're actually, it's towards the fourth quarter.
Yeah.
And again, that changes constantly because
I mean-
especially all that's going on right this
Long
moment.
story short, we're not gonna see
If we
mid fives for.
no, if it hits in the fives. I mean, because guys,
Oh, everybody's waiting.
I mean,
That's why I'm asking. 'Cause
yeah, even-
that, for some reason, that's what I keep hearing from buyers is 5.5. I don't know why they have this in their mind.
because we told them for so long that it was gonna be in the fives and it didn't happen. It didn't happen in 2023. It didn't happen in 2024. And they're still holding out in the meantime. In the meantime, I read something the other day that in our areas, in some areas, it's gone up 27%. And they're expected to continue to go up 27%. And my daughter is now shopping for a home, and I cannot tell you how disappointing that I am for a $450,000 to a $500,000 house and what it's going to buy them. And I think about what I bought, and I just can't. It's different when you have it right in front of you and it's affecting someone, and you're thinking, oh, but I just encourage your customer, and I have something, if you guys don't have it, this is what it would be if you wait. And it's literally not specific to your customer, but it's like, I'm gonna wait till the rates come down. And it literally shows them, okay, you waited till the rate came down to 4.75 or 5, but now your house is this much and your payment's actually higher because the house is more expensive. Right.
Has anybody seen offers on any of the listings?
We just were under contract this weekend for a buyer or 6 offers.
See, I mean, that's people not even waiting for rates to come down.
Yeah.
They-
What was
It
the
was
price-
a
what
very,
was the
very,
price
very
point?
unique property of 419.
Oh,
It
okay.
had those right.
That's a good price.
It was priced right, almost 4 acres.
Yeah. Oh, that's right, that's right. I knew there was something unique about it, but still, I mean, it shows that,
Half of it was
there's-
fenced.
it shows that there's pent-up buyer demand.
And while I was there, I mean, because they had it blocked off, like you couldn't, they weren't doing like multiple showings.
Yeah.
So once I talked to the agent after we got her contract, I was like, how many showings did you had? He said she lost count at 30 showings. I mean, and while I was there, it was like.
Well, congratulations.
Yeah.
Congratulations, you and your mom. Oh, please.
Right.
Like,
Gotcha. Awesome. Sorry to.
No, I'm glad. I mean, because I'd like to hear the same thing. I mean, it's
Buyers are
you're
out there.
seeing where some people are dropping some prices,
Yeah.
but then if they drop them, that's when you're gonna get, but if they're not dropping them like at two, that like I see them drop it $900 and I'm like, oh, well, let me go buy that house. And then, but every once in a while you'll see 5, but I really think it's because maybe the seller was kind of like zealous in what he thought that they would be able to get, or something, for whatever reason. But we're encouraging that. Think of your individuals where they may get tax returns, refunds, because I'm actually qualifying clients now, trying to figure out, okay, as soon as you know what your tax return is going to be or refund, if they are getting it, I'm trying to, get them set up and ready, because that's the one thing, we got to have them set up and ready.
So if someone wants to upgrade, they get their tax refund, you would probably recommend a HELOC to make the move if they want to get something more expensive, larger.
So they own a house and they want to upgrade to a more expensive house. And then you said tax refund. That's what confused me.
Yeah, they're getting it, so they're gonna be incentivized. So we
Okay.
recommend them to go with the HELOC as well, just to make that transition easier.
Well, I would recommend that they apply for the HELOC now and go and get the highest they can and talk to me. I can try and get you some direction
Okay.
for some of the.
How
programs
long
they-
does that last once they're approved?
Oh, the home equity, they're gonna close it.
Okay.
They'll have to close it. They'll have to go ahead and close that home equity line of credit. But see, also when you do the home equity line of credit before, the bank closes it. You're not going to an attorney and having all those attorney fees.
Yeah.
And so, but they need to have it now. Just think of like taking out a credit card and you don't plan on using it forever.
Okay.
The draw periods on home equities are normally 10 years. And then after 10 years, they're gonna have to set up the remaining payments for the remaining 20 years in principal and interest payments.
Got it.
But I would recommend now. And then if he doesn't use it, he doesn't use that. Yeah, so. One other thing, guys, keep in mind, if you do have an investor and or homeowner that wants to buy a house and have a rental, FHA allows duplexes with 3.5%, and they only have to have ownership, primary residence in that one unit. and they can rent out the other.
Yes.
FYI.
Can they do that with a non-related co-borrower or just that one person?
As long as the co-borrower is gonna occupy the property.
Oh,
I don't know that they're gonna accept, I'd have to check on non-occupying
but if
co-borrower.
they're occupying, they can.
Right, and I really think they can do it if it's non-owner occupied.
Okay.
But that's one of those things that we just need to make sure that's not changed, because some programs will absolutely say co-borrower is not occupying the property is not allowed, and then some will say.
Got it.
I mean, I just don't want to mislead you and what the situation is,
Yeah.
but that's a way for first-time homebuyers to start with, rentals, which will help pay their mortgage, and it's
Yeah.
3.5%.
All right.
Uh-huh.
Where are we at on HELOC rates, fixed and variable?
Fixed, I mean, what's prime now? They've dropped it again, so maybe prime's at 8, maybe. You're gonna have margins anywhere from a half to 1, 1.5, 2, depending upon it.
Okay.
Fixed, I don't know. But it's gonna vary on the person's credit score, how much they want to borrow, and the loan to value. Keep in mind, when your customer opens a home equity line of credit and the fixed rates are 6.875, and their home equity line of credit's at 9 or 10, do not be worried. I mean, we're talking about using this for short-term need if they're needing it for purchase of the house. So as long as they're not borrowing it, the rate's not going to affect it. And if it's adjustable, let it come down as the prime comes down. But the reason I say do not worry is because of the fact you're using it for short-term money, and you basically don't pay much at all to have them closed in comparison to other loan programs. So when I have customers and we do a home equity and they're going, my rate's 9, I'm like, but you may not even make a payment on it. You know, if you're using it for the purchase of your house and you move out and you sell the house, you're only going to have making payments on it before your house closes, in the purpose of having it for the purchase of the house. But I recommend as soon as they can. It just makes the qualifying a little bit easier. But again, the maximum amount available,
Now,
because otherwise they may not have enough for the down payment.
is there anything kind of like a payoff penalty in that case?
No, not typically with a home equity. Mhm.
Yeah.
And if it is, it is typically, I mean, you can always ask, but if there is, again, if they're only taking out 50,000, what is a penalty on 50,000 versus being able to get into the house or having a loan that has a lot more flexibility and not all the $10,000 and $15,000 worth of costs associated, you know, by doing the true bridge and things.
And you could use that as the high down the interest rate.
Oh, absolutely, absolutely. And you can do repairs, or what if your house, what if they get the appraisal and there's repairs that the seller didn't realize, or the home inspection comes in and you're negotiating for the seller to do it. They have the money to do it now because they have the home equity. You know, it's just a lot of different things. And then plus, just keep it in mind, because one thing that we have learned is they were saying that a lot of people have the low interest rates on their houses and they don't want to get rid of those low interest rates. But yet, America, with all the economy and what it's gone through, the debt level has really increased for so many people because just the cost of living.
Yeah.
So a lot of people are doing cash out refinances and literally getting rid of 3% or 4%, whatever it is. But by doing the cash out refinance, they're lowering their complete house budget significantly, because what are they paying interest on credit cards? Minimum rate is probably 18 to 27, and then some is 13 or 32. And so they look at what they're doing overall. But what if they have enough equity that they could do the home equity and achieve the same thing? And if the home equity rate is at 9 or 10, what have you got on your debt?
Yeah.
And then what are you may be able to pay off a car. Just-
Pay it down, you know, pay for the. principal.
Yeah, I mean, you could take your payments that you're making on these higher credit cards and apply it to home equity and just keep making payments that way. Keep in mind, if you do that with a home equity, when you sell the house, you're not gonna have as much equity, okay? And so that all has to be calculated. But honestly, if it frees up $1,600, $1,000 in someone's monthly expenses, it's really worth considering.
The compound interest.
Yeah, exactly. Well, this has been awesome. We had a great turnout.
Thank you.
Thank you.
Sorry for the PowerPoint. It's so exciting, but the copy you got was one before revision. But anyway, I am not techie. I am not techie, so. But I'm available. You guys can call me after hours during the weekend.